In this video, I want to talk about looking at the market the right way. I'm going to show you an indicator and a mindset that completely changed the way I approach trading. It really helped me dial in my entries and my exits and really getting an idea of how far markets can move during a given time period. Let's get into it. All right, I got Thinkorswim loaded up, and I want to talk about this concept, what I would term looking at the market the right way. This is super applicable to all of your trading because a lot of times people just they don't realize that the markets are driven by statistics and probability, supply and demand, and markets just don't move as far as you think they will. And sometimes they end up moving farther than you think they will. And they have what are termed as like outlier conditions, right? So I want to bring up this image real quick to kind of set the tone here, right? This is a standard distribution bell curve. We have one standard deviation right here, this dark blue area, two standard deviation, a lighter blue area, and then your three standard deviations way out at the end. Now, 68.2% of the time, the markets are going to be in here, right? And, you know, when we take, was this 34? So 68.2 plus 27.2. So 95% of the time, the markets are going to be inside of this area. And the reason why I want to bring this up is because this is something that I think is one of the key things that I don't see people talking about that needs to be discussed more in the way that I see it. I talked about this briefly in a previous video that I use Keltner channels on all of my charts. So again, these green bands right here are what is a representation of this blue area, okay? And similarly, the red bands represent this entire area, right? So the one standard and two standard deviation places. And then, of course, the purple band represents pretty much everything here, right? So if we add 4.2, right? This gives us 99% roughly of the area that the markets are going to be in, right? And you'll notice that these bands fluctuate based on volatility, right? So when there's more volatility, these bands widen because there's a higher probability that a larger move is going to occur. And so these bands fluctuate to represent that. Now, the reason why this is important, and I'm going to show you how I kind of use this, right? So this indicator right here that I looked up the code online, right, for what would be termed as Z-score, right? And there's another way to look at this that is what's called Z-score, right? And so when these little green arrows pop up right here, if I hover over this bar, right, and I'm looking at this red bar right here, and I look right here, and I come over here where it says Z-score, you'll see that the Z-score here is negative 3.09. And basically what this is telling me is that this move on this candle has moved larger than three standard deviations, which essentially means that it's moved outside of that 99.6% range that encapsulates the entire market for this particular time period right here. Now, it's important to understand that outliers do exist where, you know, external circumstances and things can happen where you can have these massive moves that happen for an extended period of time. And it's one of those things where you have to be careful that you don't, you know, get into the wrong direction of your trade when a change in trend is going to occur. But typically when we see this type of signal being thrown here, this is an indicator that says that this is a high probability place that the market is going to revert back to the mean. And you can see that, you know, they sold this off twice. They ran it up. This was the Fed, you know, coming out to lower interest rates 50 basis points. Now, this is something that occurs, you know, all the time, right? So if we go back in time, you can see that right here it threw a signal, you know, it actually continued to make a new low, but then again, it reverted back to the mean and went up. Similarly here, right, made a larger than 3 standard deviation move. This one was actually 3.64 on the Z-score. And again, this was a highly lucrative buying opportunity. You can see here though, you know, this is where you can get in trouble, where you could be looking at something like this where, you know, you see some resistance up above, moving averages kind of just trading sideways. And then when they start to dip, you know, this could be a false sign here that you would then need to have confirmation, right? And when you didn't get confirmation above this 200 period moving average, right, you would want to stay in the trade. Same thing right here when, you know, this type of doji formed where it traded up and then traded down and then again sold off. And then again, it came down here and started making new lower lows, right? Again, there's no guarantee. I'm not guaranteeing you that this is foolproof. I don't think there are any 100% foolproof methods. But I think as far as looking at the data in terms of standard distribution, using Keltner channels and kind of looking at the market in this fashion is going to, over time, give you a very, very good idea of how far markets can move and, you know, when they tend to get exhausted, et cetera, right? Because, you know, when you see something like this happen, right, and then it goes up, as soon as it gets up here to this band, if it doesn't throw, you know, larger than standard 3 standard deviation move to the upside, right, it doesn't give you that sell signal, most likely, you know, that trend can continue up, right? But as soon as you start getting these types of like sell signals, the markets start to trade sideways and then revert back to the mean before making another move up, right? And so these can be critical places where you can sell credit spreads, you can get into butterflies, maybe you do like a 0 DTE butterfly here at 5,600, like that trade right here moving sideways is going to print, okay? Similarly here, you know, you can be selling puts, you can be selling put credit spreads, you can be buying calls, you can be buying call debit spreads to the upside, right? You could do butterflies up here, right? There's just a ton of ways that you can use options in correlation when you understand that markets are just not going to move as far as you think they are, okay? I think that's pretty much it. I want to show you real quick kind of how I set this up. So if I come into edit studies, right, I have these 3 Keltner channels, and the factor is what you would think of as the standard distribution, right? So a factor of 1 is 1 standard distribution, and then, you know, that white line in the middle is a moving average. I like to set mine to 21 days, right? And then so on this one, I set the factor to 2, length is 21 days, price is closed, and I like to use exponential. Same thing for the third one, factor of 3, the moving average distance is 21, okay? You know, there's another way to look at this. A lot of people, if I just pull up like a default chart here and I come in and I come to edit studies, you could also use, you know, Bollinger Bands, right? So if I come in here and I edit this, I want my length to be 21, and then your deviation down and deviation up, let's say that we set these to 3, right? So I wanted to encapsulate 3 standard deviations to the up and to the downside, right? When I apply that here, you can see that, you know, it kind of gives you the same idea. And then again, you can see that when these markets get down here and they start getting down deep into these purple bands, they tend to revert back up, right? And when the bands compress, this is saying that this is a time of low volatility. This is where you would then look to, do butterflies, do credit spreads, do theta positive strategies where you're making money from the passage of time. And then, when those bands start to expand, it's telling you that, hey, volatility is about to come up. There's going to be an increase in volatility. And then that's when you would switch to directional bias, where you would then be buying options. You could still sell credit spreads, things like that, do butterflies directionally. Whatever works for your risk and your comfort and, your trading style, that's pretty much what you want to stick with. I think that's probably it for this video. Drop a comment, like, subscribe, turn on the notification bell. Got lots more content, lots more tips. Would love to know your opinion. If you use Bollinger Bands or you've used Keltner channels, maybe you have another idea for some content or a question you have. Would love to connect. And of course, I will see you in the next video.